Disclaimer.
Something remarkable happened on January 12th, 2026, that most Americans with savings accounts completely missed. Silver crossed $84.96 per ounce, according to JM Bullion's trading data, marking a 180% gain from just $28.92 exactly 1 year ago, as reported by CBS News. But here's what should grab your attention. This isn't just another commodity price movement or a story about precious metals traders making profits. This is a mathematical threshold that reveals the hidden mechanism destroying the purchasing power sitting in your bank account right now. And once you see how this works, you'll understand why the wealth preservation window is closing faster than most financial advisors are willing to admit. Think about your savings account for a moment. If you're fortunate enough to have one of those top-tier high-yield accounts, you might be earning somewhere between 4% and 5% annual percentage yield, according to Bankrate's latest survey data. That sounds reasonable on the surface, especially when inflation is running at 3.0% as reported in recent government figures. You're staying ahead, right? Your money is growing safely in FDIC-insured accounts while you sleep, protected from market volatility and accessible whenever you need it. That's the story we've been told our entire lives about responsible money management. But here's where the mathematics become uncomfortable. The national average savings rate sits at just 0.39%, according to Bankrate's comprehensive data, which means roughly 95% of Americans holding cash in traditional bank accounts are losing purchasing power at 3% per year after inflation. While those savers watched their dollars quietly erode over the past 12 months, anyone who converted just $10,000 of cash into physical silver in January 2025 now holds $28,000 worth of purchasing power. That's not a 3% haircut from inflation or a 4% gain from interest. That's an $18,000 real wealth difference in one calendar year, and it happened while you were being told that cash is king and precious metals are risky speculation. Pop quiz, what do you call an asset that gained 180% in 12 months, while your savings account gained 4% and inflation took 3%? Most financial professionals would call that extreme volatility, risky behavior, or gambling with your financial security. I call it the only rational response to a dollar that is being systematically devalued through mechanisms most Americans don't even know exist. And the breakout above 84 signals that we have crossed into a new phase where these mechanisms are accelerating beyond the point where traditional saving strategies can protect you. Let me put this in perspective with a scenario you can immediately relate to. Imagine you had $50,000 sitting in your savings account in January 2025, earning that respectable 4% annual yield that financial advisors praise as safe and responsible. 1 year later, you now have $52,000 before taxes. But inflation at 3% means your purchasing power is actually $50,440 in real terms. You gained $440 in purchasing power over 12 months, which breaks down to about $37 per month in real wealth growth. Now imagine your neighbor, who everyone thought was crazy, took that same $50,000 and bought physical silver at $28.92 per ounce. Today, that neighbor's position is worth $140,000 at the current $84 price. That's $89,560 more in purchasing power than you have. And it happened in the exact same 12-month period while you were following traditional financial advice. Here's what most Americans don't understand about this wealth transfer. This isn't about silver being a brilliant investment choice or your neighbor being a financial genius. This is about our dollars being systematically devalued through a process that accelerates every time our government needs to fund deficits, bail out failing institutions, or stimulate an economy that can't sustain itself without constant monetary intervention. The silver price isn't really going up in absolute terms. What's actually happening is that our dollars are going down in real purchasing power, and silver's value in dollars is simply reflecting that deterioration with brutal mathematical honesty. And then on January 1st, 2026, something changed that should terrify anyone holding significant cash positions. China implemented sweeping new silver export restrictions that fundamentally altered the global supply dynamics overnight. According to detailed reporting from FX Street, these new regulations require any Chinese silver exporter to maintain at least 80 tons of annual production capacity and obtain special government licenses that effectively weaponize the world's largest silver supply source. Think about what this means in practical terms. China didn't ban silver exports outright, which would have triggered immediate international response and criticism. Instead, they created requirements that eliminate hundreds of smaller exporters, while allowing a handful of state-controlled entities to continue selling silver to the world at whatever price they choose to accept. Have you noticed how countries don't usually restrict exports of commodities they consider unimportant? When was the last time you heard about China implementing strict export controls on aluminum or copper or iron ore? They don't, because those materials, while valuable, aren't strategic enough to weaponize. But silver? Silver is different. Silver is the most conductive metal on Earth, essential for solar panels, electric vehicle components, advanced electronics, and increasingly critical artificial intelligence infrastructure that requires massive amounts of semiconductors and high-performance computing hardware. China knows this, which is why they are implementing these restrictions precisely as the global market enters its fifth consecutive year of supply deficit, according to industry data compiled by the Oregon Group. Let me give you the numbers that show why this timing matters so much. The Oregon Group's comprehensive market analysis shows 2025 ended with a 95 million ounce supply shortfall, meaning global demand exceeded available supply by roughly 95 million ounces, even before China's new export restrictions took effect. That's not a small gap that mining companies can quickly fill by opening new operations or increasing production at existing facilities. Silver mining doesn't work that way. According to FX Street's detailed breakdown of supply sources, approximately 71% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. You can't just decide to mine more silver when prices go up, because you'd have to mine massive amounts of copper or lead that the market doesn't need just to extract the silver that comes along with those primary metals. This creates a supply-demand dynamic unlike almost anything else in commodity markets. When oil prices spike, Saudi Arabia can open the taps and flood the market with supply within weeks. When copper prices surge, existing mines can ramp up production and new projects can accelerate development. But silver supply is largely locked to the production schedules of metals that have nothing to do with silver prices, creating a situation where price signals cannot resolve supply shortages through normal market mechanisms. And now China has decided to put additional restrictions on the portion of supply that does reach the global market, right at the moment when industrial demand is exploding and above-ground stockpiles are at multi-year lows. What if I told you that this isn't an accident or an unfortunate coincidence of timing? What if China looked at the same supply-demand data you're about to see recognize that physical silver scarcity is becoming a weapon they can deploy without firing a single shot, and decided to implement these restrictions at the exact moment when Western financial systems are most vulnerable to dollar devaluation and loss of confidence in paper currency? That's not conspiracy theory. That's basic geopolitical strategy, and it's playing out in real time while most Americans are being told that keeping cash in savings accounts earning 0.39% is the safe and responsible choice. The $84 breakout isn't just a price level on a chart. It's a mathematical threshold that reveals the velocity at which our purchasing power is being transferred from those holding depreciating paper currency to those holding scarce physical assets that cannot be printed, digitized, or created through monetary policy decisions. And based on what's happening with supply restrictions, deficit dynamics, and the accelerating loss of dollar purchasing power, this is just the beginning of a wealth transfer that will leave traditional savers watching from the sidelines as their nest eggs quietly evaporate in accounts that pay interest rates that can't possibly keep pace with real inflation. Now let me show you the concrete evidence that proves this isn't speculation or fear-mongering, but simple mathematics that anyone can verify. Global silver mine production peaked in 2016 at approximately 900 million ounces, according to comprehensive data compiled by the Oregon Group, which tracks worldwide precious metals production trends. Since that peak 9 years ago, production has steadily declined to just 835 million ounces in 2025. Think about what that means for a moment. We're not talking about a commodity where production is ramping up to meet growing demand. We're talking about a critical industrial metal where the world is producing 65 million fewer ounces per year than we were a decade ago, even as prices have surged and demand has exploded across multiple sectors. Here's where the supply-demand imbalance becomes mathematically undeniable. According to detailed market analysis from FX Street, 2025 demand reached 1.24 billion ounces, while total supply from all sources, including mining and recycling, came to just 1.01 billion ounces. That's a deficit of 230 million ounces in a single year, which equals roughly 27% of total annual supply simply vanishing into industrial consumption, jewelry fabrication, and investment demand that cannot be recovered or recycled. To put that deficit in perspective, FX Street notes that 230 million ounces is equivalent to Mexico's entire annual silver output, which makes Mexico one of the world's largest producers. Imagine if Mexico's silver production completely disappeared from the global market overnight. That's the scale of the supply shortage we're dealing with right now, and it's getting worse every quarter. You might be wondering how silver prices stayed relatively stable for so many years if these deficits have been building since 2020. That's the question that leads us to one of the most important concepts you need to understand about precious metals markets: the disconnect between paper prices and physical reality. When you see the silver price quoted on financial news networks or trading platforms, you're looking at the price of paper contracts traded on exchanges like the COMEX in New York or the London Bullion Market. These paper contracts represent promises to deliver silver at some future date, and they trade in volumes that are 50 to 100 times larger than the actual physical silver that exists to back those contracts. As long as most contract holders simply cash out their positions or roll them forward without demanding physical delivery, the paper price can stay suppressed even when physical scarcity is reaching crisis levels. But here's where the evidence becomes impossible to ignore. Physical silver premiums in major markets around the world reveal the true state of supply conditions that paper markets refuse to acknowledge. According to detailed premium tracking from Bullion Star, which operates physical precious metals vaults and monitors global pricing differentials, China's physical silver premiums now exceed 100% above the paper spot price. Read that again carefully. In China, buyers are paying double the officially quoted silver price to obtain actual physical metal they can hold in their hands. Japan shows premiums of 60% above paper prices, and even Dubai, which has historically been one of the most efficient physical metals markets in the world, trades at 40% above the spot prices you see quoted on financial websites. Think about what these premiums tell you about real supply conditions. When physical buyers in the world's largest manufacturing economy are willing to pay twice the paper price to secure actual metal, that's not market inefficiency or temporary logistics problems. That's a screaming signal that physical silver is dramatically more scarce than paper markets suggest, and sophisticated buyers who need silver for industrial production or wealth preservation are voting with their money by paying massive premiums over the fictional paper price. The paper market says silver is worth $84. The physical market in China says it is worth $168. Which price do you think represents reality, and which one represents a paper system that slowly losing connection to the physical world it is supposed to reflect? The disconnect shows up in another critical metric that most retail investors have never heard of, but professional metals traders watch obsessively: silver lease rates. When you lease silver, you're essentially borrowing physical metal from someone who owns it, paying them an interest rate for the privilege, and promising to return the silver at a later date. Historically, silver lease rates have hovered near zero or even gone negative, meaning it cost almost nothing to borrow physical silver because supply was abundant and lenders were competing for borrowers. But according to the Oregon Group's market monitoring, silver lease rates spiked above 5% 5 separate times during 2025, compared to historical norms near zero. Those spikes represent moments when physical silver became so tight that lenders demanded substantial compensation to part with their metal even temporarily, and borrowers were desperate enough to pay those elevated rates to secure supply. Have you noticed how none of this information makes it into mainstream financial advice or wealth management recommendations? Your bank is not sending you alerts about silver lease rate spikes or physical premiums in Asia that signal critical supply shortages. Your financial advisor isn't calling to discuss how paper silver markets are disconnecting from physical reality. Instead, they're recommending you keep your cash and savings accounts earning 4% while inflation runs at 3%, telling you that's prudent wealth management, completely ignoring the fact that your purchasing power is being systematically destroyed by dollar devaluation that's accelerating faster than most Americans realize. Let's talk about what's happening to our dollar, because this is the other half of the equation that makes the $84 silver breakout so significant. The US dollar dropped 9% in 2025, according to analysts at DeVere Group, which tracks major currency movements and provides wealth management services internationally. That's not a small decline or normal currency fluctuation. That's a substantial loss of purchasing power in a single calendar year, and currency analysts are expecting further weakness through 2026 as the Federal Reserve's monetary policy decisions continue to pressure dollar strength. When your currency drops 9% in value, that means everything priced in dollars, from imported goods to commodities to foreign travel, becomes 9% more expensive, even before you factor in traditional inflation measures. And then there's what the Federal Reserve did in late 2025 that sets up even more dollar weakness ahead. According to Yahoo Finance's coverage of Fed policy decisions, our central bank cut interest rates 3 times in the final months of 2025, bringing the federal funds rate down to a range of 3.50% to 3.75%. Each rate cut weakens the dollar by making it less attractive to international investors who can earn higher yields in other currencies. And each cut pressures banks to reduce the savings rates they offer to depositors like you. Bankrate's forecasting team predicts savings rates will decline another 65 basis points in 2026, which means that 4% high-yield savings account you're proud of could be paying 3.35% by this time next year, assuming the Fed follows through on the rate cuts that markets are currently pricing in. Let me walk you through a scenario that shows how this creates a wealth transfer window that's closing faster than most people understand. Imagine you have $250,000 saved for retirement. sitting in a combination of savings accounts and certificates of deposit, earning an average of 4% annually. That's a substantial nest egg that most financial planners would praise as responsible preparation for your future. Over the next year, assuming you don't withdraw anything, that $250,000 grows to $260,000 before taxes. But if inflation runs at just 3%, your real purchasing power only increases to $250,200, giving you a $2,200 real wealth gain over 12 months. That's about $183 per month in actual purchasing power growth. And that's assuming inflation stays at 3%, which becomes increasingly unlikely as the dollar weakens and imported goods become more expensive. Now imagine a different scenario where you took just $50,000 of that $250,000 and converted it to physical silver in January 2025 at $28.92 per ounce. You're not going all in or betting your entire retirement on precious metals. You're simply diversifying 20% of your savings into a physical asset that has historically preserved purchasing power during periods of currency devaluation. Today, that $50,000 position is worth $140,000 at current prices of $84 per ounce. Your remaining $200,000 in savings accounts grew to $208,000 and retained about $1,760 in purchasing power after inflation. Add those together, and your total position is worth $341,760 in real purchasing power, compared to $200 if you had kept everything in cash. That's a $89,560 difference in real wealth created simply by recognizing that our dollars are being devalued faster than savings account interest rates can compensate. But here's what should really concern you about the trajectory we're on. Those physical premiums in China, Japan, and Dubai aren't declining. They're expanding. Those silver lease rates aren't returning to historical norms near zero. They're staying elevated and spiking higher during moments of supply stress. And that 230 million ounce annual deficit isn't shrinking. It's projected to widen further in 2026, according to multiple industry analysts who track supply-demand fundamentals. Every quarter that passes with deficits consuming above-ground stockpiles, every month that China's export restrictions eliminate smaller suppliers, every week that industrial demand from solar panels, electric vehicles, and AI infrastructure continues growing, the disconnect between paper prices and physical reality becomes more severe. What if I told you that major institutional investors and sovereign wealth funds are already positioning for this disconnect to break? They're not buying paper contracts on the COMEX that can be settled in cash. They're taking physical delivery of metal, moving it into private vaults, and accepting the storage costs and premiums. Because they understand that when the paper system finally breaks under the weight of delivery demands, it cannot fulfill the price. Discovery mechanism will shift entirely to physical markets where supply is already exhausted. And when that shift happens, the premiums you're seeing in China and Japan won't be anomalies or inefficiencies. They'll be the new normal for anyone trying to obtain physical silver in a world where decades of supply deficits have finally consumed the available inventory. The wealth transfer window exists right now because paper markets are still providing silver at prices that don't reflect physical reality, and traditional investors are still holding cash in accounts that are bleeding purchasing power faster than interest rates can compensate. But that window is closing with mathematical certainty as physical inventories decline, export restrictions tighten, and the dollar continues weakening under the pressure of monetary policies designed to stimulate growth rather than preserve currency value. The question isn't whether this transfer will happen. The mathematics guarantee it will. The only question is whether you'll be holding depreciating paper currency when it does, or whether you will be positioned in physical assets that preserve purchasing power when the paper system finally acknowledges the reality that physical markets have been screaming about for years. Let me show you the brutal mathematical reality that every American with significant cash savings needs to confront right now. Take a standard scenario that millions of people face. You've worked hard, lived responsibly, and accumulated $100,000 in savings that you're keeping in one of those high-yield accounts earning 4% annually. Financial advisors tell you that's smart money management, and on the surface, the numbers look reasonable. After 1 year, your account shows $104,000 before taxes. But inflation running at 3% means your real purchasing power is actually $101,000 after accounting for the declining value of each dollar. You've gained $1,000 in actual wealth over 12 months, which works out to about $83 per month in real purchasing power growth. Now let me show you what happened to someone who made a different decision in January 2025. They took that same $100,000 and converted it to physical silver at 28.92 per ounce, acquiring approximately 3,458 ounces of metal. Think about what that means for your financial future if these trends continue. If you're planning for retirement, saving for your children's education, or building wealth to achieve financial independence, every month you hold cash in accounts earning 4% while inflation runs at 3%. And the dollar continues weakening. You're falling further behind those who understand that purchasing power preservation requires holding assets that cannot be created through monetary policy decisions. The difference compounds over time, turning small monthly losses into substantial wealth erosion that can fundamentally alter your retirement timeline, your children's opportunities, and your family's financial security. But here's where this story gets even more compelling: the 84. Breakout isn't the end of this trend. It's potentially just the beginning, based on what analysts who specialize in precious metals markets are forecasting for the months ahead. According to the Oregon Group's compilation of analyst predictions, strategists at BNP Paribas, one of Europe's largest banking institutions, predict silver could exceed $100 per ounce based on the supply-demand fundamentals we've been discussing. That's not a fringe prediction from some precious metals promoter with a financial interest in talking up prices. That's a major international bank with sophisticated commodity analysis teams looking at the same deficit data, the same export restrictions, and the same industrial demand growth we've covered, and concluding that silver at $84 is undervalued relative to the physical market realities. And some technical analysts who focus specifically on precious metals are even more bullish about near-term price potential. Michael Oliver, whose technical analysis has correctly predicted major moves in metals markets over the past 2 decades, according to the Oregon Group's profile of his forecasting record, Project Silver could reach $100 to $200 per ounce by early 2026. Think about what the upper end of that range would mean for the purchasing power comparison we just walked through. If silver reaches $200 per ounce, that $100,000 position from January 2025 would be worth approximately $691,710 at current exchange rates. Meanwhile, the cash position earning 4% interest would have grown to maybe $104,000 before taxes, retaining about $101,000 in real purchasing power after inflation. That's not a 50% difference or a 100% difference. That's nearly a 7-fold difference in real wealth outcomes over a span of just 13 months. Have you noticed how mainstream financial advice never discusses scenarios like this? Your bank isn't running calculations showing how much purchasing power you're losing by keeping cash in their savings accounts. Your financial advisor isn't modeling what happens to your retirement timeline if silver reaches the levels that major banks and technical analysts are forecasting. Instead, they're telling you that cash is safe, that precious metals are volatile, and that you should stay the course with traditional saving strategies that were designed for a monetary system that no longer exists. They are telling you this, even as the evidence mounts that we are in a fundamentally different environment where currency devaluation is accelerating. And physical asset scarcity is creating opportunities for wealth preservation that won't exist once the masses recognize what is happening. The reason silver has this explosive upside potential while supply cannot possibly respond to meet demand comes back to that critical point about mining economics that most investors don't understand. According to FX Street's detailed breakdown of global silver supply sources, approximately 71% of silver production comes as a byproduct of mining copper, lead, zinc, and gold. Read that carefully. Nearly 3/4 of the world's silver supply does not come from silver mines, where companies can decide to produce more silver when prices rise. It comes from mines focused on other metals entirely, where silver is just something that happens to exist in the ore body alongside the primary metal they're actually trying to extract. This creates a supply response mechanism that is completely broken for silver compared to almost every other commodity you can think of. When oil prices doubled in the past, Saudi Arabia opened the spigots and flooded the market with supply until prices normalized. When copper prices surged, mining companies accelerated development of new projects, and existing mines ramped up production to capture the high prices. But silver? Silver supply is effectively locked to the production schedules of copper mines in Peru, lead mines in Australia, zinc operations in Canada, and gold projects around the world that have absolutely nothing to do with silver prices. You cannot increase silver production meaningfully without mining massive amounts of copper, lead, and zinc that global markets don't need, and that would crash those metals prices if you tried to produce them just to get at the silver byproduct. According to detailed industrial demand projections compiled by NASDAQ, the demand side of this equation is equally inelastic, meaning it cannot easily be reduced even if prices rise substantially. Solar panel manufacturing requires specific amounts of silver per panel based on the electrical conductivity needed to function efficiently, and you cannot reduce that silver content without degrading panel performance in ways that would make them unmarketable. Electric vehicle electronics require silver for the same fundamental reason. It's the most electrically and thermally conductive metal on Earth, and you cannot substitute inferior materials without compromising the performance specifications that consumers and regulators demand. Artificial intelligence infrastructure being built by tech giants requires massive server farms with countless semiconductors and high-performance computing components, all of which use silver in quantities that cannot be reduced without rendering the equipment non-functional for its intended purpose. What you have is a commodity, where supply cannot increase when prices rise, and demand cannot decrease when prices rise, which creates a price discovery mechanism unlike anything else in modern commodity markets. Every month that passes with 230 million ounce deficits consuming above ground stockpiles, the available inventory shrinks, and the eventual price adjustment becomes more severe. It's not a question of if silver prices will reflect physical scarcity. It's a question of when the paper market finally capitulates to the reality that physical markets have been signaling for years through those expanding premiums in China, Japan, and Dubai. And here's what should tell you that the point of no return. Window is closing faster than most Americans realize. The physical inventories that buffer the gap between paper promises and physical reality are approaching critically low levels. According to BullionStar's monitoring of global exchange inventories, the Shanghai Gold Exchange saw silver holdings hit their lowest levels since 2015, while London's LBMA vaults experienced major drawdowns throughout 2025. These aren't small percentage declines in inventory levels. These are structural drawdowns that signal physical tightness at the most important delivery points in the global silver market. And they're happening precisely as China's new export restrictions eliminate hundreds of smaller exporters starting January 1st, 2026, according to FX Street's detailed coverage of the new regulations. Think about what happens when those Shanghai and London inventories decline to levels where the exchanges cannot guarantee physical delivery to everyone holding paper contracts expecting to receive metal. The current system functions because most contract holders roll forward or cash settle without demanding physical delivery, allowing a relatively small inventory to support a massive paper market. But when physical scarcity becomes so severe that even small percentages of contract holders demanding delivery would exhaust available inventory, confidence in the paper system breaks down rapidly. We're seeing the early stages of that breakdown in the physical premiums, currently running at 100% in China, 60% in Japan, and 40% in Dubai. Once those physical premiums reach 150% to 200% over paper prices, which could happen within months if current deficit trends continue, the paper system faces a mathematical impossibility. At that point, anyone holding paper contracts who wants actual metal will simply sell their paper position, take the cash, and pay the premium to acquire physical silver in Asia or the Middle East, where it's actually available. That arbitrage opportunity destroys the paper market, its credibility as a price discovery mechanism, and shifts price discovery entirely to physical markets, where supply is already exhausted. When that shift happens, the 84 breakout. We're discussing today will look like the early innings of a repricing event that could take silver to levels that sound impossible to anyone still anchored to the old paradigm of paper prices reflecting reality. Let me be very clear about what I'm not saying. I'm not telling you to panic, sell everything you own, and convert your entire net worth to precious metals tomorrow morning. I'm not predicting the collapse of our monetary system or the end of the dollar as the world's reserve currency. What I am telling you is that the mathematical evidence shows our purchasing power is being transferred from those holding depreciating paper currency to those holding scarce physical assets at a velocity that's accelerating beyond what traditional saving strategies can possibly compensate for. The $84 silver breakout is a marker, a signpost that tells us we've crossed into a phase where these dynamics are intensifying rather than resolving. The wealth preservation window still exists right now because you can still acquire physical silver at prices that, while elevated from a year ago, still don't fully reflect the supply scarcity and deficit dynamics that physical markets in Asia are already pricing in through those massive premiums. You can still move a portion of your savings from accounts earning 4% minus 3% inflation into physical assets that cannot be printed, digitized, or created through Federal Reserve decisions before the masses recognize what's happening, and demand overwhelms the available supply at current prices. That's not fear-mongering. That's mathematical reality based on verifiable supply-demand data, export restrictions that are already in effect, and inventory levels at major exchanges that are publicly reported and approaching critically low levels. Your financial future depends on understanding that the rules have changed even if mainstream financial advice hasn't caught up yet. The safety that previous generations found in cash, savings accounts, and certificates of deposit existed in a different monetary environment where currency devaluation happened slowly enough that modest interest rates could compensate. We're not in that environment anymore. We're in an environment where our government runs massive deficits that require constant monetary expansion, where Federal Reserve policies prioritize growth over currency stability, and where the mathematical consequences of those decisions are showing up in the purchasing power differences between those holding dollars and those holding physical assets that preserve wealth. The $84 breakout happened on January 12th, 2026, and most Americans with savings accounts missed it entirely because no one explained what it really meant for their purchasing power. Now you know. Now you understand the mechanism, the mathematics, and the window that's closing. What you do with that knowledge is entirely your decision, but that decision is one you'll live with for years to come as these dynamics continue playing out with mathematical certainty. The point of no return isn't some distant theoretical concept. It's the moment when physical scarcity becomes so severe that paper markets can no longer function. And based on current inventory levels, export restrictions, and deficit projections, that moment is approaching faster than most Americans realize.